Welcome to the COB channel. Today we are going to discuss simple interest and discounting of note. In a loan transaction, there are two parties, the debtor and the creditor. The creditor is the one that lends the money to the debtor. After a certain period of time, the debtor pays not only the amount that he borrowed, but also the cost of borrowing it. This cost is what you call the interest. So the simple interest is composed of three elements. The principal, which is the amount borrowed, the interest rate, which is the rate charged by the creditor, and the time, which is the number of years the amount was borrowed. To get the simple interest, you simply multiply these three elements. Hence, the formula is I equals PRT. So let's have an example. Determine the interest rate if an investment of 37,500 pesos earns 8,437.5 pesos interest in 8 months. So we know that the formula is I equals PRT. We also know that the interest is 8,437.5. P is 37,500. Your R is unknown. And your T is 8/12. Note that the time given to us is in months, so we must convert this into years. Now we can solve for our rate. So R is equal to 33.75%. If you were to add the principal and the interest, then you would get the maturity value or the future amount. This is the amount paid by the debtor to the creditor after a certain period of time. So the formula for this is F equals P plus I, or F equals P quantity 1 plus RT. The second formula was derived from our first formula earlier. Now let's use the second formula on our succeeding problems. What is the maturity value of 250,000 pesos if it is borrowed at 5.25% for 3 years? So as discussed earlier, the formula for the maturity value is F equals P quantity 1 plus RT. Based on what's given, we know that P is equal to 250,000. R is 0.0525 and T is 3. From here, we can now solve. So F is equal to 289,375 pesos. How long will it take for 4,000 pesos to grow to 14,000 pesos if the simple interest is 12.5%? This time we are looking for T. Using the formula, F equals P quantity 1 plus RT, F being 14,000 pesos, P being 4,000 pesos, and R being 0.125, we can now solve for T. And T is equal to 20 years. In our previous problems, the time given to us was in years or in months. However, it's also possible that the time can be in days. Counting the number of days will depend on what are the assumptions used. Actual time is based on the actual number of days, such as August having 31 days, September having 30 days, and so on. Approximate time assumes that every month has 30 days each. These two assumptions are used for the numerator for t. The next two assumptions are for the denominator of t. Exact interest assumes that there are 365 days in a year, while ordinary interest assumes that there are 360 days in a year. Just like approximate time, it assumes that every month has 30 days each. So the four assumptions discussed can be mixed and matched, such as actual time under exact interest, approximate time under exact interest, or approximate time under ordinary interest. If there is no statement to the contrary, then we can assume that the banker's rule is used, which is the actual time under ordinary interest. So let's say that on December 25, 2017, a sum of money was borrowed and was to be repaid on July 16, 2018. Under approximate time, we assume that there are 30 days in a month. So December will have 5 days, since it's from December 25 to 30. January to June will have 30 days. And July will have 16 days. This will give you a total of 201 days. So under exact interest, t will be 201 over 365. Under ordinary, it will be 201 over 360. Under actual time, you will use the actual number of days. For a total of 204 days. Under exact interest, t will be 204 over 365. Under ordinary interest, t will be 204 over 360, which is also the banker's rule. Now let's move on to our second topic, discounting. Discounting is defined as the selling or endorsing of a note before its maturity date. This is usually done by those in a tight cash position. Before we proceed to our problem, here are a few terms to remember. Discount period is the time from the date of discounting to the date of maturity. Discount rate is the rate used to compute for the discount. Discount is the interest deducted in advance. The formula for this is I sub d is equal to f dt. F being the maturity value, d being the discount rate, and t being the discount period. This is pretty similar to our formula for interest I equals PRT. Proceeds is the discounted value of the amount received. Just like solving for the maturity value, there are two formulas that you can use. PR equals F minus I sub D, and PR equals F quantity 1 minus DT. So there are 4 steps in calculating for the proceeds. First is to calculate for the maturity value. Second is to determine the discount period. And third is to solve for the discount. And 4 is to calculate the proceeds. So let's have an example. On March 10, 2018, Juan made a note of 37,500 pesos with a promise to pay Paul in 180 days at 6.5% interest. Paul discounted the note at the bank on August 4, 2018 at 9%. How much was the proceeds? The first step is to calculate for the maturity value, which is F equals 37,500 times 1 plus 0.065 times 180 over 360. Second is to solve for the discount period. So we know that the note was dated on March 10 and was due on September 6, but it was discounted on August 4. Between March 10 and August 4, there are 147 days. Between August 4 and September 6, there are 33 days. So this will be your discount period. The third step is to solve for the discount. Using the formula I sub d is equal to f dt. So we will use the f that we solved earlier times 0.09 times 33 over 360. And lastly, we can now solve for the proceeds. So the proceeds is equal to 38,399.32. And that ends our video. Thank you so much for watching. If you have any comments, suggestions, requests, and feedback, leave them down in the comment section below. Don't forget to like and subscribe.